Good morning or good afternoon, depending on what side of the country you're joining us from. Thank you for joining us today. I'm Charlie McQueen, President McQueen Financial. I'm excited here. I've got a great panel for our annual activity where we update everyone on what we see in the industry and really to be prepared and planning for 2024. It's hard to believe we're hitting into 2024, but that's what we are here and want to make sure we're all prepared and ready to start going in that direction. All right. Joining me today, I'm really excited of Craig Cecilia here, our Chief Investment Officer and Managing Director. Craig, thank you for joining us.
Yeah, you're welcome. Glad to be a part of the group today.
Also, I have Heather Shepperly here, Vice President, Head of Asset Liability Management Activity. Heather, thank you for joining us.
Thanks for having me. Looking forward to it.
And also Dan Martin, last but not least, I should say, Senior Consultant, Head of our Valuation and Advisory business. Dan, thank you for joining us.
Yeah, thank you. Glad to be here.
All right, so just a little bit of administration before we kick off activities today. If you have any questions, please, you'll find on your screen a Q&A button. Please use that, not the chat button, and click on there and put your question in. We will answer it along the way if it is a timely question that fits into the conversation. Otherwise, we'll answer it at the end of the presentation. Also, today's webinar will be recorded as usual and we put onto our YouTube channel and on our website. All of our previous webinars are on our website, so please feel free to go check it out and see things we've said in the past. So with that, we had a lot to discuss today, so we're going to hop right into this. Again, the purpose of today's webinar is to give you guys insight for 2024, provide with you our projections for 2024. We're going to look at economic activities, interest rates, inflation, ALM, including loans and deposits, investments, some mergers and transactions. With that, there's a lot of comments have been coming in. Looking forward to this presentation. Last year, we did predict that we would have a 5% deposit reduction in 2023. That caused a lot of comments and I'd say a little hate mail might have been the way to put it, but a lot of fun comments and entertaining discussions. Unfortunately, that has come true for a lot of people. So today, we want to spend some time looking at this and thinking about where we're going forward from here. So with that, we're going to kick it off. Craig, I'm looking forward to having a little discussion on inflation because as I look at these inflation numbers, it looks like there's still a lot of inflation in this world.
Yeah, there really sure is, and it is the hot topic of what's happening with the Fed. It touches every one of our clients there, and I love this chart that you have there. It's the last, say, 20 years, give or take here, and we did peak out in 2022, and we're starting to see a good deliberate trend down. That's kind of going towards what the Fed's mandate is, right? Full employment, price stability, and price stability is another way of saying, manageable inflation.
I like that term, manageable inflation. I like the term price stability. One of the things, though, is I put gas in my car yesterday. I didn't feel like there was price stability for some strange reason.
Well, be thankful you don't live in California. I think they're close to $7 a gallon. I'm just making that number up, but I know it's between 6 and 7. It's up there. We were about 360 here in Michigan. I think it is, and it's come down really from $4 or something like that. So it's come down quite a bit.
Yeah, it has come down a bit. And one of the things we talk about, and on a previous chart there, we talk about the three types of inflation: the consumer price index, everything, the black dotted line, which really spiked up high; the consumer price index, ex food and energy, which I really like to follow. It's now down to roughly 4.1%. Then the PCE, personal consumption expenditure core index, at 388. It hasn't come down as much, but it never rose as much. But you get a bit more granular. I want to share this next slide here. Could you give me a little insight to this?
Oh, yeah. First and foremost, isn't that a beautiful chart? It's kind of coming down, and I'll put it into context here. We started to get outside of price stability in the first quarter of 2021, right? That's when we kind of broached that 2% level for inflation, regardless if you're talking about the core PCE or core CPI. Since then, we kind of peaked out in 2022, and now it's coming down. And we've got two different ranges here shown. One is a little bit longer term range where you can see the slow descent of inflation. It's actually inflation's increasing at a decelerating rate.
So it's increasing at a slower pace. I love that.
I love the way you say that. Tomatoes. And then, but if you look at more of the shorter term, that second range, it's actually coming down fairly quickly over the shorter period of time. We're still above where we want to be. We are at on the core PCE, we're at a 388, and that's kind of a great measurement of all the customers of our companies and what they're paying and how they're spending money on and their disposable income. And then the core CPI, which is not quite as dynamic, but very important number, is also down to a 414. So we've come down a lot so far.
Yeah, so I think what we can take from this is that as we look into 2024, inflation is still going to be higher than what the Fed wants, but it's going to be getting closer to their target of 2%. Is that a fair statement for 2024?
I think that's a fair statement. And we just got to make sure other expectations, like in the energy sector, with what's happening, we got a couple of wars going on still, right? And
two, maybe, at least one. Yeah.
Right, absolutely. And impacts for energy and oil is going to be big for right now going forward, because even though it's not core, it should impact everything else that we're doing. Oh, you have it right there.
Yep. So, and this is energy prices here. This does include electricity, lots of things. And we can have being in Detroit here, we're all automotive experts clearly, and we could talk about, rolling into electric cars and the timeliness, but we are also, besides having high gas prices, we have very high electricity prices, which will cause some trouble with manufacturing and households also, but definitely higher than we want in the energy. As we look into 2024, Craig, do you see this roughly staying the same, coming down, going up? Where are you looking at this?
I think based on our economic cycle, we got two different things pulling at it. And I think overall we're going to have energy stabilization to slightly coming down. That's where I think it's going to be.
Well, part of this is going to go into the employment situation. We talk about the Fed's dual mandate, which is price stability and full employment, and they're working towards price stability. We're still a little too high in inflation. Full employment, we've been at full employment basically outside of the little heartbeat there of a little pandemic since about 2014, 2015, right? So it's a tough spot right now. We're probably going to have to see some unemployment go up a little bit to get that price stability. Is that a fair statement?
I think so as well. And it's just terrible to think about it that way, that we're going to give up some jobs, right? We're starting to see a little bit of a shift in industries where you get more part-time jobs, or people working a couple of different part-time jobs instead of one full-time job. That's going to make a little bit of noise in that data. But this strength in the employment world has given the fuel for the Fed to not pivot, meaning not stop raising rates, or at least drop rates to this point. And we do expect that to slowly change, especially in certain industries as we have economic cycles taking place. You had mentioned the auto industry. That's a good example of that industry and what's taking place right now with the strike.
Yeah, definitely a lot of unique things. One of our Monday updates we did the other day talked about all the strikes happening around the country right now. Definitely seeing some unique pressures in Michigan, but for the automotive industry, but strikes are happening everywhere, which is, maybe it's causing a little bit of that unemployment link to pop up a little bit, but I would expect to see the unemployment rate start to drift up a little bit here based off of all those activities. But if you're on strike, it does not count for unemployment, something really, really important. So moving a bit out of the inflation section there and talking a bit about projections, you've been calling yield curves beautiful a lot lately. We've had an inverted yield curve, and it kind of looks to me like a yield line at this point. This is seemingly saying that maybe we're getting done with the recession that didn't happen. Is that what this is telling me here? Or am I misreading this?
Well, I want to do an analogy here. We'll go down the path you want to, but first I want to just say that line reminds me of a perfect cast with a fly rod. If someone's out there fly fishing, kind of stretching that line out before it falls. But it is beautiful, and we're looking at, and we expect a continued flattening to a positively sloped yield curve to some point in time take place in 2024. We've been playing with that a little bit on the longer end of that curve, between, say, the 5-year and the 10-year, where they've been jousting, if you will. So right now in this chart, you can see it. They're they're at 470. They're right on top of each other. So, but we expect it to continue on. We got to remember, full employment's there. The other thing that's helping that Fed is our GDP. We've got a positive GDP taking place. And even though those expectations for a recession or recession-like economy is still there for majority of people, we think 2024 is going to, not get a huge recession. We're still going to have decent GDP, which should bode well for the shape of the yield curve and what all of our customers really can make money off of, right? More
Yeah.
profitable for us.
Yeah, a good positive slope yield curve really helps us out making money. And if we look back in the long-term situation of interest rates, one of my favorite charts, I know you've all seen this a number of times, red line is Fed funds, the blue line is the 2-year Treasury, and the black dotted line is the 10-year Treasury. Where we are today off on the far right there, you'll be able to see that we appear to be starting the topping process that looks very remarkably similar to 2005 and 2006. And if this continues, we would expect rates to remain here for a while, then start to head down. So it looks like we're beginning that topping process, which goes right into what you say, Craig, because the next thing from this is we have this flat yield curve for a period of time, then it goes back to a positive slope yield curve. So we're beginning to see some good technical indications that we've reached the top.
Yeah, well said.
Thank you. So with that, one of the things clients ask us on a regular basis, besides our interest rate projection, which we think we're getting to the top here, is people ask all the time, what's going on with the housing market? Our home value is going to go up or down. And I tell you, this is the most unique housing market I've ever seen in my life, because you have two classes of people. You have those that own houses with a 3% or lower 30-year mortgage and those that don't own houses. And buying a house today at an 8% mortgage is a very different payment structure than someone with a 3% mortgage. I do think we're going to see home prices, stabilize a bit here because they've become very unaffordable. You feel the same way, Craig?
I really do. And I think one of the components that lead to that, in addition to the higher loan mortgage rates, is the supply issue. We've been struggling in the U.S. with supply for a long period of time, especially when we get into that 500 and lower or 600 and lower. You pick that number. We don't have enough supply for people to be moving into these houses, so it just becomes unaffordable. I think that's going to help continue to support relatively stable housing prices.
Yeah, it's difficult to build houses today. It's very expensive with labor costs and material costs. And so this is going to be a challenge for a while. We still see apartments coming online, and that's going to continue to take some part of this, but it's definitely going to be a tough spot. Heather's going to talk a little bit about ALM in a couple of slides. And one of the things we're going to talk about is looking at ways to help people buy homes and seeing that there's definitely some changes in the activities happening on that. One part of the economy, which is always a fun one to talk about, is the stock market. It's the great cocktail party conversations. And one of the things we see here is, well, the stock market did roar all the way up from pandemic lows when we realized everyone could be day traders, to really the beginning of 2022, where we started to see things really kind of fall back to normal levels. We did have a remarkable recovery back in 2023 here, getting not all the way back to high levels, but we're beginning to see a little bit of resistance there, Craig. And a lot of times people talk about the 10-year Treasury, and given where the 10-year Treasury is, that it's difficult to have valuations look good. How are you feeling the stock market here?
I love the stock market. Don't get me wrong. We have a majority of our assets under management are in the fixed income world, and we're fabulous at doing that. The stock market has been a real good indicator of wealth for most people, right? And this is something it's really important to point out. We just talked about housing and the housing wealth that's built up over the last few years. Now you kind of look at, we've had a little bit of softening in the stock market, but if you go down to a trend analysis over the last several years, there's a lot of wealth built up in the US. And that, with the economic slowdown that we're experiencing and the inflation, it's one of the things that's helping us remain a little bit positive here in the outlook. Now, Just remember though, COVID cash is gone. You know, the people that did benefit, the programs, right for the right people, they used up that money. It's kind of going away. So we're going to start to see, and you almost said you haves, not the haves and haves nots, but you said there's two different types there and of people. And we're going to have some of those economic struggles as we're going to talk about a little bit later from a credit perspective going forward.
Yeah, definitely some challenges there.
Yeah.
Well, you've got this favorite chart of yours. It looks like we're playing some sort of board game, or we're, I don't know, shooting at targets with guns, getting ready for hunting season here. But what do you got here?
Well, I was actually playing a game with my kids with the marbles and they just kind of fell across here, right? But
Yeah.
I do like this, and it doesn't get talked, it rightfully so, it doesn't get talked about a lot. And what it is this is a chart of the Fed members of the FOMC and where they think interest rates are going to be. It did get updated in September as the last update for them. But I wanted to share this with you for one or two things. One is typically they'll know kind of a direction, similar to Fed funds futures will give you the right direction. They may not know the right velocity or the severity of the rate changes, but I like to look at just that 2024 column. It's the second column from the left, and that's a representation or the actual dot represents a member's opinion of where overnight rates will be. And you can see there's one member that's kind of way out there. That's 6.25% on overnight funds. And then but the majority, which is the gray line or green line, help me in colors. I'm kind of colorblind.
Looks the green to me. Let's go with that.
All right, we're going with green there. So that's kind of the average of where the dots are for them. So they're expecting that it's going to be pretty much unchanged by the end of 2024, somewhere between that 5 and 5.25 rate where we're at now. The blue line is actual Fed funds futures here. So the market participants, I would say the non-Fed members, is where they feel that rates are going to be, and that's going to be come down a little bit in 2024. Very little though.
So I think we take from this from a planning standpoint, the Fed dot plots and the market is showing that most likely rates through the rest of 2023 are unchanged. In 2024, there's a chance of rates lower. And then as we move farther, obviously harder to project, where the Fed funds futures are predicting a little less down. But this does go back to our viewpoint on the charting area that we've pretty much reached the high point of interest rates at this point.
Yeah, I concur.
Well, and we have here the Fed funds futures. The Fed funds futures say that as of today, which I know we've showed this to all of you before, the never perfect, obviously, this is the betting in the Fed funds market, but it has a rate cut in June of 24. So mid-year next year, which is not far off from what you believe also. Is that correct?
Yeah, I think this is going to be very close to what reality happens with our economy. We do have a positive GDP, we have inflation coming down, and we do have a little bit of slowdown in certain sectors. So we need to really pay attention to that. And I think we're going to have a little bit lower rates, not massive next year.
All right, well, you do show here positive ISM manufacturing orders, although they're lower level, but still coming up a little bit from recent lows. That's another example of some positive business activity.
Right on.
So with that, here are projections that we have for interest rates for 2024 throughout the year. Craig, anything you'd like to highlight here?
Well, one, this is just hot off the press, right? So okay, everybody on this is the first you're seeing our latest and greatest predictions for interest rates. And the bottom row is really important to pay attention. I'll point out two other things, but that bottom row I really want to focus in on, and that's inflation, our expectations on inflation, where it's at today, by the end of the year, coming down slightly. That fourth quarter is going to have a little volatility because of the energy industry that's happening right now, even though it's not core. It does have implications and effects to the core, and then just slowly coming down throughout the year. And the other thing I want to also point out is the trending of the 2-year versus Fed funds. Now, Fed funds is not coming down quite as much in our expectations, but the 2-year is coming down because as the Fed starts to approach that pivot point, and market anticipates rates coming lower, we should see the shorter and the belly of the curve come down a little bit more than the longer end, like the 10-year, which doesn't come down quite as much. So that's going back towards that, hopefully that re-steepening of the yield curve and a normal curve for us.
Yeah, so maybe a summation for 2024 is that the yield curve should start to shift towards a normalization. And at that point, we'll maybe see rates come down a little bit, not a ton, but we expect to see them starting to move in that direction. Inflation does subside. So good projection, but one of the tough things for this, unemployment most likely goes up in this type of environment because of the slowing of the economy. So wonderful. Thank you, Craig. I really appreciate your insight on all of that. That helps us quite a bit. And as we want to take this economic viewpoint, and then as usual, we want to roll into our asset liability management discussion. And Heather, I want to talk a bit about maybe kick stuff off deposits and where we see deposits going this next year.
Yeah, thank you, Charlie. ALM has had a lot of stress lately because of the current market. This has really put a lot of pressure on our risk position. And examiners are hyper focused here, especially on items such as NEV, our margin, and especially getting into liquidity. So this graph really gives us a really good view, and this is our M2, our money supply. What we experienced during the pandemic was actually an equivalent of a money growth of 5 years within 5 quarters. If you look at the left-hand side of this graph, you can see in the 1980s all the way up to 2020 that this was a slow, steady increase over time. And once the stimulus packages went into play, this really spiked that growth of deposits. So now we're starting to see that downturn come down here, and this is what that quantitative tightening goal to get us back down to is about $7.5 trillion. And the goal is to get down to this by probably about summertime of next year. And what this means for us is a continued stress on liquidity and reduction of deposits. So as we go on to the next page, we can really start to see, where some of these downward trends are going. And we've experienced most of this over the last year or so. This is where that transition of all of those stimulus dollars kind of go away. As the stimulus was in, we had lots and lots of deposits. We didn't need to move our rates. We didn't need to compete with the market, but that has changed significantly. And you can really see a lot of that runoff here on this right-hand side of this graph of these deposits starting to leave us. And the stress that that's putting on our balance sheet is causing our margin to squeeze. So this is an area that you really want to focus on in regards to retention, durations, making sure we have this proper balance on the balance sheet. And deposits are hard to come by right now. So being able to price appropriately is vastly important. And looking at the trends that we're seeing on our balance sheet is going to help us plan for the future, especially going into 2024. So as we go into the next piece here, you can see some of the changes in regards to the cost of funds. As we had talked about, when we had all of this money in, we weren't fighting for these deposits. So we were able to keep our costs very, very low. Well, that's not the case anymore. We're really having to fight for these deposits, and we're seeing our cost of funds skyrocket, especially over the last 12 months. And you can see how steep upward trend these lines are for what this cost looks like. And we've seen over a 200 basis point increase in the last 12 months. And do we expect this to go away anytime soon? Probably not. This is going to be here at least getting into this 2024 budgeting, planning for this increase of cost of funds. So we need to make sure that we're prepared for this. We're doing everything we can with every other part of our balance sheet to offset some of the stress and pressure that we're seeing from these increased costs. And a lot of this is because of the shift that we see maybe from non-maturity deposits into term deposits, borrowing costs, so on and so forth. So we really need to make sure that we're monitoring and watching these costs rise, as this does put so much pressure on our margin position.
So Heather, what I'm seeing here from these two charts, the first one here is that deposits continue to run out. Now we had a lot come in. They're not all going to go away, but a significant number of them are going to go away. We did predict 2023, the deposits would decline by 5%. A lot of people have been asking us 2024. We believe we could see up to additional 5% reduction of deposits, again, because of the quantitative tightening and then no government helicopter money coming in. And so we do expect that. So as you plan for next year, please plan for potentially up to another 5% reduction of core deposits. And then looking at this chart again here, the cost of funds is between a SpaceX and an Knievel jump. I don't know which one we want to put that, but a good 50, 60 degree angle up there. This cost of funds is going to cause some margin pressure. And it's something we really need to make sure we're ready for. So that's one of the other things as we plan for 2024, plan for much higher cost of funds and plan for potentially some margin compression.
Absolutely.
Well, and that really lends us into the next aspect here is lending, right?
Yeah, I mean, what are we going to do with the deposits we do have as we start to bring that in? We need to make sure that we're taking advantage of the asset side of the balance sheet. And it's interesting looking at the lines of the change that has happened. As you made reference to Evel Knievel here on our cost of funds end, we don't see as much benefit from the asset side, at least from a trend perspective. Many wanted to be as competitive in the market as possible when it came to pricing loans, simply because we wanted to be able to bring in new lending. There's still opportunities there, but we need to make sure that we're pricing appropriately. And we can see over the last, recent activity of that, we have done a good job increasing the pricing, but we haven't done it at the pace of which we've been forced to do from liability or cost of funds. So this is a big concern when looking at margin, making sure that that asset side is getting as much benefit as we can. And we're going to talk a little bit more about making sure we are pricing appropriately, just knowing those liability costs are just not going to go away anytime soon.
Yeah, it's you kind of wished for the Evel Knievel jump here also, but it is definitely much more muted. And one of the things as you think about 2024, you want to keep growing your loans. And as Craig was telling me a little bit ago, and we're having a debate here earlier, that we do expect loan demand to still be strong. And Heather, you're saying from what you're hearing from all of our clients running ALM reports that loan demand is still very strong. Is that correct?
Yeah, it's definitely there. It just may look a little bit different than what we've experienced historically. So these are the things that we need to monitor and watch for and see where those opportunities actually exist. Earlier, you made some mentions to the housing market and those interest rates being booked at such low yields. We want to make sure that we are understanding what that's going to look like for us and where those opportunities have shifted to.
That's
So
Yeah, that's hard, but that's a great point. And I do think here, just for budgeting, you want to make sure you focus on growing loans in 2024. It's really important to turn over your loan book to the next levels. And then speaking of that, lots of interesting here, but a bit of loan growth, not as much as maybe we want. It was flat some years there, but there is definitely loan growth.
yes, or that slowing increase. So it's still there. There's still opportunity. It's just not at the increasing volume that we may have seen historically when we were in a lower interest rate environment. But there's definitely still opportunity here, as you can see that slow, steady increase of demand. So this is definitely some good news for us. There's definitely opportunity out there in lending, and we want to take full advantage of that wherever we can.
Definitely. All right. Well, we do have a question, but I want to skip that. Let's finish talking about loans for a second. I want to come back to this question in just 1 second. Because Heather, there's something you talked about here. There's definitely a lot of things happening in loans, but they don't appear to be in the mortgage world.
No, they were, and they were beautiful when they were. We saw some incredible volume and refinancing occurring in late 2020 and into early 2021. And that's that kind of that middle arrow that you're seeing that kind of focuses on what was kind of the peak of refinancing, the activity that happened during that time period. And most of the loans going on the books for the mortgage side were booking between 2 and 3%. So consumers are not planning on refinancing any of these loans anytime soon. And that's kind of what's brought us to what you can see on this far right side with this large reduction of refinancing activity. There's just not a lot of incentive in the market, as we're seeing a lot of mortgages well over 7%. It's just way too expensive to refinance or to even purchase. The supply and demand that you guys were mentioning earlier with those housing values has really put a lot of pressure here. But what this does give us an opportunity for is looking at all of those mortgages that have gone on at 2 and 3%, and the housing values being as high and holding those values for a longer period of time. This really opens up a kind of a shift over from standard conventional mortgages to shifting over to more of the equity side. And that's really where some opportunities are starting to rise for us on the offset of those locked in 2 and 3% mortgage rates.
Yeah, historically, and as you think about the success in mortgages, but as we look to 2024, it's most likely not getting gain on sale of 30-year mortgages is what you should plan on. So from a budgeting standpoint, we're going to talk more about different types of lending growth here. And I think, but it won't be your traditional 30-year mortgage is how we should budget.
Right. And it's been interesting watching the trends that have happened of where some of this demand is. And because of inflational activity and that pressure of just daily overhead costs. We've seen a lot of unsecured lending really pick up. We've seen credit card rates go up quite a bit. We have payday alternatives and even getting into other types of unsecured. There's a lot of demand there simply just to stay above water. But as we kind of shift down and look at that bottom arrow, you can see this is really looking at those equity lines. And the line right above it showed in that 21-22 a lot of demand, even over 16% in 2022. That's not really available for us anymore, as you see this drop down to only 8% demand. But when we look at those equities, you can see that that was kind of slim to none in 2020 and 2021. That is a very different story now. We're seeing a lot of demand with equities, reinvesting in our homes. We may not be able to afford to purchase and upgrade into a larger home, but with that holding those values, we can actually reinvest and remodel our kitchens or do additions, whatever the case may be. But there's definitely some great opportunities here. So this is what we have to identify is where can we go as we go into 2024? Does the lending look the same, or do we need to pivot? And as we pivot, we need to make sure we recognize where those lie, and then also what risks may go hand in hand with that. As we've seen, autos continue to be some decent demand here, and you can see those numbers are still at a decent level, that there's still demand in these areas. It hasn't gone away, it's just slowed a bit. But we do need to prepare for other items such as increased losses, as was mentioned earlier. With those stimulus money is just not there anymore. We saw next to no losses during that time period. That has started to change and start to normalize. So making sure that we're paying attention to not just the type of lending we're doing, but also making sure that we're paying attention to the losses that are attributed to those product types as well.
Yes. So Heather, thank you. As we're looking at this, what this does say that there will be loan growth in 2024, but it's changing areas. And so just to be paying attention to, credit cards have obviously skyrocketed, $1 trillion outstanding balance. We're seeing people take more junior lien positions, second mortgages, and not refinancing to do modifications and additions. But we do want to be very careful. A lot of the things that are coming up here are more difficult credit, and we would expect to see loss reserves higher and things much higher. So with that, you do have some comments here on the auto lending. Man, the cars are worth a lot today, I guess.
Well, prices of cars and values of cars had really peaked up in about 2021, and those values are starting to come down quite a bit. So this is another area to monitor and watch as those values are starting to reduce as we work through an indirect program. So as we do that, we want to make sure that we are doing proper fee structures. We are building up our pricing appropriately, taking into consideration some of these additional stress factors that we didn't have to prepare for before. And as these values are starting to drop on those used cars, this is definitely an area that we really need to monitor and watch as those are starting to come back down to more normalized levels.
Yeah, I think this is what I take from this here, and I appreciate that, Heather. It's very important information as we budget into 2024, that there are going to be some interesting value changes. We may see declining values in cars, we may see declining values on commercial real estate, different things. So just be very cautious and make sure you're looking at the assets carefully that you're booking. Definitely a little bit of time of upheaval here. One of the last couple of things on loans we want to talk about is pricing of loans. And I think, Heather, I've seen people getting much better in their pricing, meaning more in tune with the market today. What are you seeing?
We're starting to see those numbers start to pick up a bit as we're realizing the stress of the increased cost of funds. It's really pushing and driving us to ensure that we're offsetting that with the lending. And we're finding at first, many institutions were concerned about increasing loan rates, thinking that the volume would reduce with it. But that really hasn't been the case. Everything is increasing and consumers are prepared and understanding of that. So making sure we're taking all of these items into consideration. If we were to invest in risk-free treasury instead of a loan, we can earn at least at 5.5%. So as we price loans, we want to take into consideration that ongoing stress of losses. Really pay attention to what those CECL values are giving us and bring those into play when looking at pricing. Planning for servicing, and then obviously our desired ROA or ROE out of this. And this is our starting point of that conversation. As we start to build in risk-based pricing, that's where we have to adjust for those spreads and prepare for those expected losses that may occur over time. So this is definitely an important piece as we're budgeting for 2024, being diligent about how we are structuring our pricing for our lending.
Yeah, we have seen people get a lot better throughout 2023 on pricing. Remember, you don't have to price where your competitors price. You need to think for yourself and do what's right for you. Most clients are telling us that they're booking loans in the mid eights at this point. So I think the 750 is a bit of a low number here, but a great example. So thank you, Heather. You know, what all this comes down to, we have unfortunately a significantly increasing cost of funds and a slower increasing yield on assets today, and that's how things work when rates rise very, very quickly. Profitability is going to be a challenge, and I want to make sure that we're thinking carefully about profitability as we go forward. And that is good loan pricing, making good investment decisions, and also being very conscientious in the deposit side and doing well there. One of the things we talk about in a lot of our ALM meetings, investment meetings, is really talking about ways to generate more non-interest income. Unfortunately, here, one that's a normal one for everyone is the mortgage area, and that's not going to be around for a while. I expect maybe 2025 or 2026 we might have some busyness there, but it's going to take a while. We're seeing people get into other things, and I think brokerage and SBA. I like SBA today as a way to put loans, maybe a loan that you don't love, but it's still a good loan to put in SBA versus on your books. Are you seeing people start to diversify a little bit, Heather?
Absolutely. We need to take advantage of or offsetting some of the reductions that we see in other areas. Like you mentioned, that mortgage fee income, it'll come back at some point, but it's not going to be at the same pace. So making sure we're taking advantage of these other opportunities to offset those rising costs is going to be very important.
Yeah, thank you, Heather. That's really, really, really good stuff. I do think everyone should be thinking carefully about different opportunities for non-interest income, as it's going to really be needed to supplement this as rates have come up and caused some earnings pressure. And then this next year, we'll definitely have some margin pressure. All right, well, I want to change directions for a minute, and we're just going to leave Dan to the end. That's always the fun part. But talk with Craig a little bit more about some of the things happening and what we should plan on for the investment portfolio management in 2024. So thank you, Heather, again for your comments. All right.
Yeah. Well, go ahead, Charlie.
It's a big yield change, all yours.
Absolutely. When kind of trying to determine how to put into context the 10-year treasury yield and historical, there's a lot of things that get priced off of the 10-year, as we know, is the risk-free rate, now the 10-year, one being mortgages. The spirit, though, is one thing that's hit everybody was our unrealized losses as rates have run up, and that's not what we want to really talk about. One of the things I do want to bring up in this is that it's getting expensive out there. We just talked about loan buildup pricing up to average of 7.5 for ideal. Actually, we're seeing a lot higher lending rates. It's getting very expensive for people to finance things and to run your businesses, whether you're looking at that trailing inflation that has come up. And so the cost for businesses and the finance and the run is getting up there, and that's indicative of this 10-year treasury. And as we look at that on the, could you scroll that one up there for me, please?
No, I
Thank
apologize. Yeah,
Thank
no,
you.
keep the information in front of you to help you out.
Yeah.
I'm getting good at
So-
this stuff eventually. Yeah, go for it.
Yeah. So the one thing that we're going to talk a little bit about is that when we look at where we're at today, it really is unique to everybody's balance sheet, but being able to put on certain longer term duration, maybe not going crazy out there, but as the Fed approaches that pivot point of what is happening with interest rates, that's a good time to really thinking about tweaking that asset yield duration. And we'll talk a little bit about not having convexities in a little bit. And this is all what this treasury yield curve really makes me think about, a variety of things, making it more expensive. Now, getting into what is costing companies and what is happening to margins and what is inflation impact, we wanted to throw up here some credit default swaps. And this is for just generic. It's not on a specific company. It's for an investment grade index for the US. And you can see that spike that we've experienced over the last 2 years in credit default swaps. This is truly a measure of what the market feels of the probability of the average investment grade company of defaulting on their debt. really critical to be really thinking about it as we go and look at managing our investments. Think there's a lot of value out there, which we're going to see. And you can look at this next page if you like, Charlie. There's a lot of value out there as you get into credit related investments. This is a yield curve of about through 5 asset classes that are most common on all of our balance sheets. And if you look out the curve, this goes from left to right. 1 year is on the left and out 10 years is on the right, and the actual yields for each of these asset classes. Your highest yielding asset classes are credit related, right? Taxable municipals on top. Then you have corporates on there. So we're thinking about this along with the credit default swap probability going up on defaults. You really got to pause and do your homework as you're managing your portfolios. We think that it's a great time, if you're not already diversified into these asset classes, to actually invest into them, right? Especially going into this market into 2024. But the credit is actually crucial to manage this risk, just like in the lending world, right? So,
Craig, what you're saying to me here, it's really interesting. What I'm hearing you say, we're at a highest level for credit default swaps since, going back to the start of the pandemic. And so that does show some of the concern out there that people have. And then the yield spreads there. So as I budget into 2024, I think that makes me think about a couple things. One, I should expect my asset yields to continue to come up as I reinvest. But two, there's potential of some more losses happening, maybe my CECL reserve going up as time goes by also.
Yeah, well said there.
Okay. Well, lots of stuff going on in the credit world. You just covered, municipal and corporate credit's going to be a little bit tougher, we think, in doing our homework. But talk to me a little bit about this word negative convexity. What does that mean?
So it is something, and history does repeat itself. So we felt it was really important to talk about it today and what to really plan for 2024 as liquidity may stabilize. We're probably having a lot of people building into their investment portfolio. You want to basically be able to rely on those higher yielding assets to be with you for a longer period of time. And in order to be able to do that is to have with very little negative convexity in your portfolio. A great example is a callable bond. Rates are really high right now, and if you're booking a bond in your investment portfolio at 5.5%, 6.5%, you don't want to have a call option in there where the issuer can call it away from you in the end of 2024, because then you get stuck reinvesting in lower yields. So trying to limit that negative convexity on any type of asset you're putting in there, whether it's credit related in corporates and munis, or if you're starting to get back into the mortgage market, right? You want to be very deliberate in modeling your CMOs and your mortgage-backed securities to make sure that they'll perform relatively well with the rest of your balance sheet. So your whole higher yielding asset classes don't come back to you in a lower rate environment.
I'd say I get nervous at this moment about high premium mortgage-backed securities and rates going down. And we've seen that happen in the past. So doing your homework is really, really important here. And speaking to your homework, a lot of things that we should be thinking about as we wrap up 2023 and into 2024 is swaps and selling some securities at losses and a couple different things here. Does that make sense to you?
It really does. People have had a pretty decent year this year, quite frankly, even though it's just rates going up. Some were able to lag on the deposits, and asset yields repricing a little bit better. Looking at swaps, selling out of some of your securities now, and taking your unrealized loss and layering that back into non-negatively convex investments is a great option to be doing. You'll make up those losses over time. You'll be locking in a good yield, and you'll really get a good performing institution going into 2024. Some of the offsets that can be out there, we do have several clients actually have looked at some assets they've ignored for a while, like the Visa B shares, right? Monetizing those, using that pickup and offsetting the losses. But the higher yields that you can get and playing that yield curve right now really offsets those losses. And then the process of selling is super important in this environment. the brokerage market is very quiet right now. Not a lot of transactions happening, and they are hungry to make revenue. And one of the things we also want to warn people on is making sure they have a good, reputable broker on the other side and put them up in competition to many others, not just one or two. When we put out bids when selling securities, we're putting at a minimum of 10 other companies that we're putting up from a price competitive standpoint. It's extremely important this in market, because as we get towards, some institutions might think of things as being illiquid, especially in the credit world. If things go down the credit stack, we might have a lot of wide bids out there where you can leave a lot of money on the table when selling a bond. Extremely important to look at that going forward.
Yeah, so as we look into 2024, I really appreciate those comments. One of the things is that a registered investment advisor in the work we do here, we're really good at selling bonds, and highly recommend you work with us to sell bonds, or someone to sell bonds in this nature versus just a one-off, because selling is a more difficult thing. A lot of people don't realize that. But again, looking at 2024, we need to continue to improve the portfolio, make changes to the portfolio, and do lots of changes. So thank you, Craig. I appreciate that. We're going to hop over now and talk a little bit with Dan Martin here, a little bit about some merger valuations and transaction advisory. Dan, thank you for joining us again.
Yeah, appreciate it. Saving the best for last, right?
Absolutely.
So we've had a very interesting year in both the transaction merger marketplace. This graph here is really just showing the trend over time. We're kind of below where we were, earlier in this decade. And we've run into some interesting trends this year that have happened that I expect will continue to happen in 2024. So we're down a little bit on volume. If you think about it, we had a couple bank failures earlier this year. That's going to increase regulator scrutiny. That tends to just slow down the whole process, leads to less volume overall. We've had some issues this year with the increase in rates from a purchase accounting standpoint. So when you merge two institutions together, you have to mark to market the balance sheet. So you recognize, every loan portfolio that's at a discount, every investment discount, that becomes a real loss day one. So that's really preventing a lot of this activity. So for 2024, I expect as a whole merger activity in both the bank and credit union space to be a little slower. That being said, there are certainly some pockets where we expect it to continue. So Charlie, if you want to flip over to that next page, we can see here that that orange line kind of has shown over time this activity of credit unions purchasing banks is really something that's here to stay. Through August 31st of this year, we're at 10 transactions. I expect probably by the end of this year, we'll be above last year's record year of 14. Into 24, as this becomes a more popular activity for those that can handle it. We should continue to see increased volume. Another thing that's interesting this year is we have larger banks being sold. So not only are we seeing a total number of deals increasing, we're seeing the size of the transactions increasing as well as more players get involved.
Dan, I appreciate that comment. I do think here, as we think into 2024, the valuation issues are not going to go away. We're still going to have significant valuation issues with unrealized losses on investments and loan portfolios, which is definitely making things a challenge. So, yeah, they will continue. I agree with you, but just for budgeting purposes and planning, you got to think, if you are interested in selling or merging, it's definitely going to take some unique activities right now to get that opportunity completed.
Yeah, this slide kind of goes back in hand with our bank purchase trend that we expect to continue. A lot of our concentrations really in the Southeast there and Midwest. I expect in 2024, we may see some increased activity in other markets, the Northeast, the West Coast, as more and more people looked as this as a suitable strategy to grow their institution.
Yeah, definitely a lot of unique stuff here. We do see some population trends happening in some states with a lot of banks that are going away from the purchases, but definitely some neat numbers here. There's definitely a trend you can see, and we'll see things continue. I do agree with you, Dan. All right, branching. We got some strange things happening, and this is just the month of August. Is that right, Dan?
That is correct. So really, if you look at this on a whole year picture, we're losing, call it 2,000 branches annually. So really, I think the takeaway from this is, in 2024, really coming up with a strategy and looking at how you're operating today. Do you need all your branches? We have clients that are looking at disposing of branches. Really, what is the best way to run your institution? So as you plan and budget, kind of taking a look at that and establishing what makes sense for you.
Yeah, definitely need to plan. People are changing and what they are changing. And speaking of planning and being strategic, it's really important to have a strategic plan here, isn't it?
Yeah, I think one of my favorite quotes is failure to plan is planning to fail, right? So, some people may not consider M&A activity or transactions or mergers on an annual basis, but as this becomes more and more common, we see continued stresses from the market, whether that's a deposit standpoint, lending standpoint, interest rate standpoint. This is something that everyone really needs to take a look at and have a plan. If we're looking to grow in specific areas, how are we going to do that? What are we looking for? Do we need liquidity? Do we want to expand geographically? Do we want to add an SBA line of business? And really determining that strategy, and that's certainly something the team here can help you with.
Yep. So in 2024, you need to have a strategy, which makes perfect sense here. But there are some challenges we need to be prepared for also, correct?
Yeah, I think some of these are fairly basic. Competition, everyone experiences competition. Technology is ever evolving. Those are some of the big ones. The two I really want to focus on are, one is income. So if you're looking to engage in this activity, really setting up your balance sheet, maximizing your income today, whether that's through setting up an employee benefit account or charitable donation account, taking advantage of those things, and maximizing that income so you can really maximize capital. Now, let's say our capital isn't ideal, we're less than 8%, or we're looking to take on an acquisition. Maybe somebody has a large loss on their loan portfolio or investment portfolio. We can utilize subordinated debt to kind of fix that and help facilitate a transaction. So there are options, if we don't think we can do it with the structure of our balance sheet today, to kind of get us over that hurdle.
Yeah, I appreciate that, Dan. A lot of unique things. And I think, as you say here, the market challenges 2024 is you need to do some planning and be prepared and think about different ways to handle things. Definitely a different market we're in today. So thank you, Dan. I appreciate that. And I want to go through some 6 points that we really want to highlight today and go through some of the questions that have come in. So really appreciate all those questions. But Craig here, the Fed's on hold for the remainder of this year and most of next year. Is that what we should take from here?
Affirmative. Mid-year, probably a rate reduction of 25 basis points, but they're going to be slow and deliberate, just depending on how volatile how volatile employment is and if it is resilient and combined with inflation expectations.
Yeah, the employment side is going to be a difficult one. Dan, related to the interest rate projections, we had a question come in about mortgage servicing rates. And someone was wondering if they should budget for some impairment to their mortgage servicing rates. I'm thinking my answer is, and please agree or disagree, is probably not in 2024. I would expect them to stay relatively unchanged in 2024, but 2025 would be probably the time frame I'd start to see some negative impact to the valuation of mortgage servicing rates. Or maybe Craig can add into the end of 2024 might be when we start to see the negative impact if our rate forecast comes through.
Yeah, I think that's a reasonable assumption. Just a reminder, MSR values right now are, pretty close to all-time highs. So we will see some, write-downs in values in the future, but 25 seems like a reasonable expectation there.
All right, mortgage servicing rates, for those that aren't know what MSRs are, but mortgage servicing rates, which are things we book when we sell mortgages. All right, point number 2 we want to bring up here, and then Heather, we talked quite a bit about this, but we're looking at flat to negative 5% deposit growth. Is that what you foresee for 2024?
I would say that's a pretty accurate statement. As we continue to see that tightening in the market, we're going to continue to see that pressure on liquidity. So deposits will continue to decline in 2024. So to prepare for that.
Yeah, I do think it's going to be tough. We're going to see some non-maturity deposit pressure continue, especially with really high money market rates that we're seeing in the brokerage world. CDs we expect to grow and probably quite a bit of borrowing growth in non-core funding. Is that correct?
Yeah, we've actually already seen a number of new borrowing structures starting to come into play on balance sheets, really helping kind of control some of that cost of funds as that continues to rise. We can really control it a little bit better when it comes to borrowing structures.
You know, earlier today, we were talking, and Craig, you did point out, plan for more stress. It's going to be deposits are not going to be easy for this next year, and I think that was a really good way of putting it. And Dan in his presentation was talking a bit about different ways in planning and really thinking about planning for other deposit products. What else is out there? How are things changing? So I really think that comes into place. Um, Heather, maybe options, but duration. What are your thoughts on managing duration?
Well, that's where we have to identify where we are with Neve. Values have really put a lot of pressure on our Neve position. So as we're looking at different lending opportunities that look a little different than it has in the past, making sure that we're doing some matching of the two sides of the balance sheet, that we're complementing what we're doing in borrowings to go hand in hand with where that lending opportunity may lie and a little bit shorter durations compared to those long-term mortgages that we're so used to historically.
Yeah, we definitely, if rates do start to come down, which we expect, we don't want to lock in long-term borrowings. We want to be very conscientious of that. Now, a question that came in, most of the financial institutions in my area are very competitive on maturity deposits through CD specials, which definitely I think we can all agree to that. But there's not much competition in rates for non-maturity deposits, and everyone leaving them pretty darn low. Do you guys expect that to continue into 2024?
I would expect that to continue from the non-maturity side. It's such a fast impact to our cost of funds as that happens immediately. And some of that competition has actually shown that it's not helping our liquidity position. So we're seeing more aggression in regards to pricing more on the term side than the non-maturity.
Yeah, I definitely think there's going to be pressure, and I think especially when you look at some of the money market rates that are out there right now that we're seeing in some of the brokerage areas. So I do think, as much as I hope they stay low, I am nervous there's going to be some pressure that comes out in that area. So I'd be prepared for pressure, which is one of the reasons why we talk about focusing on getting more loans on the books and margin. Is it's definitely going to be a challenge to earnings, especially if we see our money market rates and checking, savings type rates jump up dramatically in yields. Craig, you anything you want to add to that, or you feel good with all that?
Nope, I agree.
All right, I love that. I concur also.
Mhm.
Well, our next spot here is looking at loans, and it is very interesting here. We want to keep putting loans on the books. We don't want to stop doing that because that's the best way to improve our earnings. Quality is a concern. I know, Heather, you talked a bit about that, and but also yields are up, which is wonderful. So it's good to see those. We do expect loan losses and delinquency to come up this next year, which is something we need to be prepared for with our CECL modeling. Heather, any other comments here?
No, just continue to monitor that. They are going to more normalized levels, so it's not a major concern, but it is an increase compared to what we've experienced for the last few years, as that was slim to none in regards to losses. Things are starting to pick back up, so just be prepared.
Yep. So a question that came in on lending, which was really interesting to me, is how will electric vehicles change the value of used cars? Just to quickly answer that, I do expect that the migration to electric vehicles isn't going to be as fast as what the government wants, because it's difficult. And as I got my first electric bill with the split out peak, non-peak times, I don't want an electric car. But I do think that there's going to be definitely some positive value to gas-powered cars for a while. All right, from there, we'll hop into the next point here. Investment projections. Craig, got a couple of comments you want to make here?
Yep, just kind of thinking about 2024 is making sure we're properly positioning the investment portfolios for the rest of the balance sheet and expectations. And that can be involved not only liquidity and whether we're going to be able to preserve it through existing deposit products or new ones that we'll bring on or you'll bring on. but also from a lending standpoint and what your lending goals are. We want to make sure that the investment portfolio properly provides that liquidity and collateral that you need and supplement earnings if you're not a heavily lent out institution, and properly positioning that duration. If you do have a core portfolio in there, slowly look to modify that duration as the Fed starts to look to pivot on their direction of interest rates. Extremely important is that credit focus, amping up the frequency of reviewing them. Don't just rely upon a credit report, but understand the financials, obtain them and read them is extremely important. There is right now, and there is going to be a lot of fabulous opportunities in the credit world with some great yields. It's a wonderful time. I don't think in the last decade and a half, we've had a better time to be building a fixed income portfolio based on where interest rates are right now. So it really needs to be taken seriously. Don't avoid credit, just make sure you manage it properly. And then the duration I already mentioned. Think actions to take. Talking about building a portfolio, we do have existing portfolios out in our audience that a lot of unrealized losses. It's okay to rethink and use today's environment to take advantage of, hey, let's just change the way our portfolio is going to perform on a go-forward basis. Look to sell off some investments at a loss and reinvest in the higher environment.
Yeah, really appreciate that, Craig. That's a great insight and things to improve, because margin is going to be key here. And so improving those asset yields by changing the investment portfolio around is extremely important. But this is definitely going to be a challenge, and we need to make sure that we're really focused on the margin and that we've got good loan yields out there and we've got good deposit costs out there. Really, really important that we spend our time on that. And our last point here, as we wrap up the webinar here, a couple of minutes behind schedule, but Dan, volume is going to be down here, and the valuation is going to be difficult. What can we do to be prepared or to improve our options to be able to grow?
Yeah, I think it comes down to the two things we mentioned earlier: really maximizing your earnings, making sure you're getting the right margin on your products, and then really coming up with a plan. So if you're going to run into a liquidity crunch, M&A may be an option. If we can find an institution for you that has available liquidity, that is certainly something we can look at with a plan.
Yeah, it's a very good point there, Dan. I appreciate that. But making a plan, being prepared, and making sure you're maximizing earnings no matter what. If you want to remain independent, you want to merge someone in, you want to buy something, maximize your earnings and making sure your earnings are in a really good spot. So with that, a couple quick questions have come in that we'd like to think about. We were asked some questions about NSF and overdraft fees. We don't have a sense that regulation will be enacted because of the earnings position of financial institutions, but that is something we definitely keep our eye on, and we want to make sure that we have a good margin to work through this. With that, there was another question that came in: is should we consider hedging against falling rates? And that's something that's really interesting. We've got to be really careful about hedging at this point, and if rates do stay unchanged for a period of time or do start to come down, as Craig's predicting, that you want to be careful with the amount of cost to put that hedge on the books. And we'd love to discuss that with you at length. So please reach out to your MFA advisor to go through that. So with that, I want to thank everyone here today. Craig, thank you for joining and participating in the webinar.
You're welcome. Great conversation today.
Yeah, wonderful. Heather, thank you very much. Appreciate you here and your insight. Great information.
Thank you for having me. This is great.
And Dan, thank you very much for batting last there and coming up with a few comments, and I really appreciate the help here.
Yeah, thanks.
And with that, please reach out to your advisor. They'd happily share the webinar with you. So call your advisor if you'd like a copy of the webinar. And then coming up next, we do have a webinar coming up, a CECL update and tips coming up here in about a week and a half from today. And we look forward to seeing all of you there. Thank you very much, and have a great rest of your day.